This is Hi-Fi Radio with Wolfgang Klein and Jack Hardell. Toronto's news, today's talk, 640 Toronto.
My friends, time just flies by indeed. Another weekend is upon us, and we're digging our way through what is typically the toughest month of the year for stock investors. One day at a time, and indeed, this too shall pass. And of course, every investor in most asset classes, especially real estate investors, of course, are waiting for the central banks globally to stop raising interest rates. But the message from those bankers is we're not stopping anytime soon. And again, an asset class that is so dependent on the cost of money, i.e. the cost of financing, is real estate. And I think it's an understated statement until it's, well, almost too important not to discuss. Jack and I, again, good evening, Jack, but you and I have been talking about the influence on real estate prices for the last 10 years and how much cheap money has driven prices higher. Correct?
It's true, Wolf. Canadians have had a love for real estate, and I'm going to say it ended with some euphoria at the end of, or at the beginning of this year, January, February, March. Markets started to turn, and it was because of interest rates. So, traditional economic factors matter. The cost of capital, the cost to finance a project or to invest in real estate is really biting into the wallets of Canadians right now, especially the higher levered ones.
Yeah, and again, it's all about that monthly payment. Monthly payment. If I can afford the monthly payment, if it's cheaper than rent or comparable to rent, why not? The only issue is what happens if and or when that monthly payment goes up. And again, so many people are just accustomed to interest rates going lower every 6 months or so until that trend stops. Now, who better to speak to about the effect on real estate through higher interest rates? Mr. Frank Leo, the Lion. He's been around since the recession of the 90s. Guess what, Frank? That's when I bought my first home. 11.75% is what my interest rate was at the time. Good evening, my good friend. Frank, I do hope you are well. Please, jump in here and talk to us.
I am. Thank you very much, Wolf. Appreciate it. And Jack, thank you for having me. Yes, a lot has changed with the interest rates and real estate, so it's on people's minds. But you mentioned something, Jack. Wolf, that the interest rates were a little bit higher back in the 90s. And I think we've gotten too used to these wonderful low rates that really are unprecedented in history. So that's why for the last, long while, when you did go and get approved for a mortgage, there was a stress test. So you were approved for actually a couple of percentage points higher than what you were applying for. And so now this comes in handy because the people who did get a mortgage should be able to withstand some of the increase in the mortgage rates.
Oh, without question. And guess what, Frank? I'm one of those people. A variable rate mortgage. Oh, delightful. Indeed. I borrowed money, Frank, 2 years ago at 1.65% variable rate. Did I want to lock in at 2.5%? Why would I do something like that when I can borrow money at 1.65%? And then, sure enough, rates began going up, and here I sit, paying now close to 5%. What does that mean to me, Frank? And yes, I can afford it, but it means I'm shelling out another, call it $45,000 a year in interest payments. I repeat, I have to now spend another $45,000 a year in simple interest payments. That money is not going to therefore go into the real economy to buy underwear, for example. Not that I'm not going to buy new underwear, my friends.
For sure. It is dipping into the disposable income of families, and of course we take that very seriously. One of the things that we have to really look at is readjusting to a more traditionally or historically normal interest rate. And so that's where we're headed, a little bit higher, but that is something that we had to expect because we were at such a, all-time low that it couldn't be for the long term. But I'll share with you some good news because I know that a lot of bad news was out there, and we're talking about Toronto, which is a big city, fourth largest city in North America. The sales, they focus on some of the negatives. So I'll give you some of the stats. Last month, in August, there were 5,627 sales. And that's the number that it was. But if we compare from August 21 to August 22, there's a 34% drop in sales. And so people were pulling their hair out until we kind of remind them that last year was an all-time record sales. All the stars had aligned and sales were very high. So we did expect a decrease. What most people don't know is that from July of this year to August of this year, sales were actually up. Right? There were more sales. So that was about 11 to 12% increase in the number of homes sold. And also, prices were up by 2%. So what that is showing us is that we have a resilient market. If you remember, even in the high times, what we were told is that there's not enough homes out there for the amount of buyers. That reality has not changed. So I can't talk about, the world or all of Canada, but I'm talking about Toronto and the GTA. We have a strong, support for this market that, is really showing us that the market is not really, going down drastically, that there is some demand and the prices are being maintained, and the supply is actually less than what we would expect it to be.
There's no question, Frank, there is a supply issue. The global real estate market is very tight on supply. And we're seeing that from multiple markets. The question I want to ask you as a Torontonian in Toronto proper, from peak prices, where do we sit today? How far away from peak are we? Or are we still at peak prices in Toronto proper?
Well, there was a spike, as you mentioned earlier, as John mentioned, between probably end of February, early March is when we saw the decline when interest rates started going up. So that was the peak. And from that point, it depends where you go, but it could be anywhere, 15%, 20%, depending on where you are. It has come down. But remember, those prices were skyrocketing every week. We were talking about removing bidding wars. There wasn't enough supply. It was a crazy time. You couldn't keep a home on the market. Well, that was not sustainable.
You're telling me a typical home in Scarborough on a 50-foot by 120 lot, an old bungalow, that perhaps is down about 15% from peak price that you think that you said was stretched.
Absolutely. There's been an adjustment for sure.
And so the same thing in Little Italy. Remember that, and it made the Toronto Star. Was it a garage in a back lane that was sold for, you know the story, right?
Yeah.
What was it? I think it sold for like $1 million.
Crazy.
Do you think would that piece of real estate, that postage stamp, still be holding that value, or you think that's corrected as well?
No, it's corrected as well. I'm sure it all has corrected. So, one of the things we have to mention, though, is that, what happened back then, so the prices were higher, but what was cheaper was the cost or the price of borrowing money, so the interest rates. And so when someone buys a property, they're not just buying the property. So even if the price is lower, the cost of the mortgage per month is higher, so the monthly costs really haven't changed a whole lot.
The monthlies haven't changed. The price has been adjusted on the asset price, whereas previously what was happening was interest rates were going down, and so therefore people were taking on more debt because the monthly didn't change. It's interesting. I know Jack is trying to grab the mic off me. Jack, over to you, my good friend.
Yeah, thanks a lot, Wolf. And the market certainly has changed. Frank, would you say that we're in a healthy market now, just with rising interest rates? Some of the, I'm going to say, more sane market. But is it a buyer's market, a seller's market? Is it balanced? And what are some of the tactics that you're seeing in terms of negotiating? Because before it was just like who would come in with the wildest bid and they're going to take it. What are sellers doing now, and how are they positioning their properties, and how are buyers, negotiating as well?
Well, it is a more sane market in the sense that it's more sustainable, because if we had rapid inflation, as you know, it can get away from us and cause us tremendous problems, and we don't want that. In terms of market dynamics, there still is not enough homes on the market. We look at about 5 to 6 months is when you get a balanced market or going towards a buyer's market. We're about 2.5 months now of inventory. So it has gone down. It was typically in July, it was at high of 3.5, but now it's down to 2.5. So we're still in seller territory. The prices are still strong, and it still is a seller's market, but it's better for buyers because buyers now. Sorry, go ahead.
No, I was going to say, right, but in this environment, so say a year ago, you put your house out. If you think it's worth 1.5, you maybe put it at 1.3, and then someone would come in with a $2 million offer on it. I'm going to assume that's not a good tactic right now. So how are sellers positioning themselves, and what are buyers using, I guess, as leverage for negotiating?
Well, I think the way it works is buyers are looking at getting the best home for their dollar, and they're looking at prices going down. Sellers are hoping to get the prices that they were getting in February and March. So that's what's happening. But because interest rates are not frozen, they're expected to continue to go up a little bit, and so as long as that is the case, that's going to make the cost of borrowing higher, and the pressures to real estate to go down. So if you want to get more money for your home, the idea here is that you should be the next home to sell, because if the next home is selling at a lower price than the previous home, the one after that will be even lower. So you're chasing, right? So if those are the factors, remember the government has a lot to do with this. We don't have control of the market. If I can share one great analogy of the market, I remember someone asked Stan Lee, about his Stan Lee being the Marvel Comics, creator, and he says if you had two characters, for example, Wolverine fighting Iron Man, who would win? And you know what he answered? Whoever I want to win. So the government has control of the economy. They can, reduce or increase interest rates and create situations for price easement or price restrictions on properties, and that's what we don't know. But the way we're going right now, it seems that there's downward pressure on the properties.
The show is Hi-Fi Radio. Each and every Saturday, Jack and I bring you a show about money here on 640 in Toronto. We're talking to Frank Leo, a.k.a. Frank Leo the Lion, one of Canada's preeminent real estate brokers, highly knowledgeable in a very important asset class. And, of course, he was talking about a man who I met back in my CP24 days, Mr. Stan Lee. What a cool man, and may God rest his soul. But I like that response. Whoever I want to win the fight, says Stan Lee. I wish I had such power. But guess what? I get to choose the guest for this radio show along with my buddy Jack, equally powerful. We chose Frank Leo for the next hit. Stay tuned. We're going to get right back to him. It is a show about money, and every now and then when the world goes kind of crazy, it's kind of funky town, I must say. Funky town in real estate, funky town in interest rates, lots of funk going on, but we're trying to make some sense of it all. As my good friend, I tell you, when you step back, maybe elevate to 30,000 feet, and you look at the big picture, trust me, we will get through it. The interest rate hike will end. Now, Frank said a little more hike coming. I'm going to say a lot more hike coming. And I think Jackson is sitting in my camp. But we still got another about, 0.75% to a 1.25 coming at the market between perhaps now and year end. So the market is certainly bracing itself. And we saw an inflation report this week that showed inflation remains stubborn above the economists' expectations. So the U.S. Central Bank will be raising interest rates. When is that? That's next week, I take it. Yeah, it's on Wednesday the 21st, the FOMC. I'll play some YMCA maybe next week for that one. Frank Leo the Lion joining us. We're going to talk a little bit more about the real estate market right here in our beautiful city. Tell me something, Frank, if I may, just for a second, because you have a big brain, and I know you think beyond your immediate front and backyard of this beautiful city called Toronto. Nationally speaking, and also regionally speaking, which markets have corrected the most, and how is Vancouver holding up? Because that has been the most expensive city in Canada for probably 20-some-odd years now. Can you speak much about those markets, just anecdotally?
Absolutely. Vancouver is holding its own as well. I mean, obviously there's been a reduction in price like Toronto, where you're getting the more pronounced decreases is in areas where people have reached out and moved further away. I think COVID had something to do with that as well, where you didn't have to stay close to work, and people moved a little bit further out, and now they have to come back closer to their work, and driving back and forth has become a problem. There's extra costs. Gasoline is up as well. So there's other factors I think are creating a more difficult market for homes that are outside the core where the employment is.
Well, the other point, of course, is that word inflation. And Jack has been running into my office 3 times a day this week. Wolf, another client complaining about inflation. Hey, Jack, you're certainly picking up the vibe, and the message has been pretty clear. But the piece of inflation, and again, when you look at the basket of the components of inflation, you start to drill into the formula. We all know food, energy are key components to inflation, but lodging costs, I think that represents about a third of the CPI index. And within that is rent. And as housing perhaps is coming down, but interest rates are going up, you're not seeing a change in your monthly mortgage payment if you're making a new purchase. However, if you are renting and you just switched from apartment A to apartment B, 10+% increase, plus those people who moved out to 905, 519, 705, who now have to come back to to Toronto, are not necessarily buying in this market, they're renting in this market. So speak to the rental market. And again, I maybe parlay that into this may be the way to get into the housing market is by buying yourself a home that actually can be partially rented, because certainly rents are at a premium right now, and space is limited.
Exactly, but you got to be careful. So I think people don't realize one thing, and I think this is very important. Rents right now are very high, and many people have mortgages that are still low because when they booked their mortgages, they were at the lower rates. They're not going to have to renew for 2-3 years down the road. And so as a result, we don't feel the full effect of these interest rate increases for a year and a half. So people are renting out instead of selling right now because they're saying, hey, you know what, I can cover my expenses and be okay because the rents are higher, and that is true. But once they have to renew and their mortgages are increased, those numbers are harder to manage in terms of paying their expenses. But what will also happen is that there'll be more rentals maybe coming on the market, and those renters may move on to a lower rent when there's more supply. So it's not a long-term strategy. Although the rents are high, they're not going to stay high based on what is coming down the road.
I want to talk about price anchoring. Jack, this is an area that you're very keen on talking about. People anchoring their house price to previous peaks. How many discussions are you having with clients, and are your fellow agents having with clients? And how easy is it to get people who own a home to have them readjust their market asking price to realistic market prices as opposed to previous what's called high water marks? And I see investors high water mark their portfolios all the time. And friends, you understand what I'm talking about? Basically, when you watch your stock account or your house value and someone tells you what the high price was, you think that is the permanent price, knowing, of course, prices do fluctuate. So talk to us about that, Frank Leo.
Well, this is a symptom of the market right now, and typically in the last 20 years or so, we haven't had a long-term decrease in prices, unlike the early 90s where it lasted 5.5 years. When we had 18 properties, for every 18 homes for sale, 17 expired, never sold, only 1 sold. And it took some time to readjust to the current pricing. So based on what we're seeing, inflation is not going away. Interest rates are going to stay here for a while, and these price adjustments may be longer term. So I think people need to readjust their price positioning for their homes, or they will lose much more money. Time is against them. If you're going to sell sooner rather than later if you want to get more money for your property.
Jack, what's your comment on all that?
Well, Frank, you've been through the bear market of the 90s. How does this, because I'm going to say we're at the initial stages of it, and real estate is, I'm going to say inefficient asset class just because, the stock market that Wolfgang and I deal with, prices adjust every single day. They adjust in the real estate market, but you're only looking for one specific buyer. So how does this bear market, I'm going to say in the first 6 months, compared to the early 90s, which lasted 5.5 years that you experienced?
Well, I hope it doesn't go for 5.5 years, but the beginnings are we're moving in a direction that is definitely causing some concern because as prices adjust, people aren't expecting this. We've seen it, and we know what happens. And when you're readjusting your price point, and if you don't do it right away, what happens is the price that you were initially able to obtain for the property 3, 4, 6, 7 months down the road is substantially less. You could be losing $100,000, $200,000 on your property if it continues to decrease. And so that's where people don't understand. I need that money doesn't matter. The need or want for more money does not increase the value of your property. You have to understand what's happening out there, see what the buyers are seeing, and be able to adjust to the real market conditions.
And then what would you be advising buyers then? Because you're saying, if you're going to be selling a property, you want to be the next sale in a down market. What are buyers looking for, and how are they positioning themselves? And how are you advising them?
There's two things. I mean, if you're buying and selling, it really doesn't make a difference because if you get less, you pay less. So that balances itself out. If someone's getting into the market as a buyer, you have to be very careful of the cost of borrowing money because it's really making it more difficult. A young person told me that they applied for a mortgage back in February and they were qualified for $500,000. They went to the same institution, they have the same employment, and today they qualify for $98,000. That was actually before the latest increase in interest rates.
Sorry, Frank, repeat those numbers, please.
We have someone went to the institution that they bank at and was pre-qualified for a mortgage of $500,000 in February. Before the increase, they went again to see what they qualify for, and the bank, same bank with the same job, now $98,000 is what they qualify for.
That's 80% less.
That's what happens, yes. So it's the ability to borrow. So even if prices are lower, but the cost of borrowing is higher, many young buyers can't get into the market because the cost of borrowing is just so high. If you have all cash, it's a different opportunity for you, and great, but not many people do have all cash.
So the lending standards have gotten more stringent. So let me ask you, Frank, therefore, on balance, is it an easier market today for first-time home buyers than it was, say, a year and a half ago, or is it basically the same struggle, just a slightly different flavor?
It's I would say more difficult. The banks were more willing to lend money at the higher prices, low interest rates. They were more confident. The market was going up, so there was equity being built on a daily basis. Today, they're much more conservative, and they are not as easily lending you money, so that's making it more difficult. The benefit in this market is this. Buyers are able to really look at homes, not be rushed. They can pick the right home, the right amenities, the right location, and therefore they're making a better purchase. That means that they don't have to move as often, right? They can buy a better home and be better off long term.
Are homes, if they are priced correctly, Frank, are they still selling within, say, 7 to 10 days, or is it taking longer even if they're priced correctly to sell a home? Because I am seeing some for sale signs in my neighborhood, and they've been up now for well over a month. They're not moving. So either they're mispriced or, I don't know. You tell me.
If a property is priced well, we've been very fortunate. We had a great month in August, and we started off the month as well. They're still selling. There's buyers out there, but, I mean, buyers are looking at opportunity to buy at today's prices, and so that's the understanding. I mean, just like the stock market, real estate's the same. We don't know when the bottom's going to be, so if you have an opportunity to get in and you're able to borrow the money and the numbers work, jump in, because it's about time in the market, not timing the market.
Well, I think real estate even more so, because I think generally speaking, real estate goes up with the broad economy, and if you're in a good city, you'll go up plus an extra couple of percent. What we have witnessed, friends at home, for the last 10 years with real estate, outpacing most asset classes year in, year out. Again, that is not normal. Mean reversion must occur. Do you agree with me, Frank, or disagree with me?
Absolutely. Real estate has been a stable long-term investment, but this has been very accelerated, and it's wonderful because, of course, I love to see people make money in real estate, but the reality is that long-term real estate has been a constant, 3 to 6% increase over time.
That's it, and accept that and be happy with that, which means you got to basically be very patient when you buy a home. And I would say again to first-time home buyers, it is my personal experience with a sample size of, say, 3, is buy as much home as you possibly can afford and stay in it longer rather than buying less than you can afford and then flipping, because flipping is expensive. Sorry, Frank.
Great advice. Let me share this with you as well. This is very important. The problem that we have with housing is something that we need. You can't just buy it or not buy it. You're paying either your mortgage or you're paying your landlord's, but you're paying a mortgage. So let's get into you're paying yourself as soon as you can.
That's very smart. It is for savings. And again, rates are still very low today. With each monthly payment, even on your first monthly payment on the 30-year amortization, over half of that monthly payment is going to create wealth. In other words, it's debt reduction. I think when rates were at rock bottom, I think it was about 80% of your monthly payment. But when Frank, Leo the Lion, and the Wolf on Bay Street bought their first homes, my first monthly payment, 90% of that went to service interest. Frank knows what I'm talking about. He knows the math. And that was 12% versus, what is it, call it 5% today. Final thoughts, a few of our clients and personal friends of mine are snooping around at the cottage market. Any comment on what's happened with prices up in the cottage country in Ontario?
Absolutely. The cottage market was on fire, but there's a lot of factors that affected that. I mean, COVID was an aberration that has really changed the way we live in the last couple of years. Being locked into our province and not being able to go anywhere, those cottages have gone through the roof, as well as pools and homes has gone through the roof. When it opens up, will it be the same? We don't know. But it definitely got a spike in interest because of the ability not to travel.
What about the Calgary market? Oil's been a lot firmer, and that was a market that got hit so hard with lower oil. Obviously, oil has come back. Yeah, I still think the Calgary real estate market is still well off its peak, and that's before the interest rate hikes that we have now witnessed. Do you have any opinion on that? Any anecdotal comment?
I'm seeing that as well, and the Calgary it's fluctuating because of the resource-based economy that it's in. So it's going to have those fluctuations, and as long as you have a good stomach to handle it, you're fine. But be careful; it's a different market than Toronto or Vancouver.
Oh, no, without question. You want to go boom or bust, that's the province to do it in when it comes to Canadian living. Frank Leo the Lion, an absolute pleasure to spend some time with you. Continue on with your successful voyage at helping people find beautiful homes to raise their families and create wonderful memories. But make sure you do it in a judicious manner. Indeed. Hi-Fi Radio, we're going to speak about the cost of money. Drew Donaldson, a mortgage broker, is going to spend some time with us just to round out the discussion on, a very important asset class. And Jack and I, we like to talk about assets. Stay tuned.
Don't go anywhere. There's more Hi-Fi Radio in a moment on 640 Toronto.